Good afternoon. My name is Josh Strittmatter, and I would like to welcome you to Strittmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation is titled Introduction to the Cash Management Strategy. For those of you that don't know us, give me 1 second here. Slides are not moving here. There we go. We are Strittmatter Wealth Management Group. We are a registered investment advisor, been in business since 2007. We are certified financial planners and fiduciaries. We specialize in retirement planning, investment management, estate planning, and real estate investing. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please don't hesitate to type in those, and we will be happy to answer those for you. Also, we will be sending out a replay of today's webinar via email, so if you miss anything, don't panic. You'll have the ability to watch this again. And you are welcome to forward these presentations and any of our presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professionals before taking any action on any of the information in this presentation. For more information, including key disclosures, please visit us at our website at strittmatterwealth.com. And then a little bit about me. I am Josh Strittmatter. Again, I'm the CEO and owner of Strittmatter Wealth. I started this company back in 2007. Prior to this, I was a financial advisor with Ameriprise and was there for 5 years as a trainer and an advisor. My background is I have a finance degree from UT Arlington, and I'm a certified financial planner and a certified retirement counselor, and then specialize in investment strategies and helping clients to grow and protect their wealth. Also work with a lot of business owners as well. And that brings us to our introduction to cash management. So, what is cash management? One moment here. There we go. What is cash management? Well, this is a strategy to structure your overall handling of your income, expenses, savings, and investments to optimize financial stability and growth. It takes a look at how you budget your money, both before and during retirement, monitoring your cash flow, so all the ins and outs, making sure you have liquid assets available for when you need them, and then strategically allocating funds to meet short-term obligations while achieving long-term financial goals. Why is this important? Well, this is kind of the foundation of a financial plan for yourself. So making sure you've got a good handle on how you spend money is very important. Before you can know where you're going, you have to know where you're at. So defining where you're at and defining your budget is a key part of what we do as financial planners for our clients. And there are several benefits that you would achieve by having a strategy in place. The first is ensuring financial stability. So again, awareness, I think, is a big part of that, just understanding where you're at in terms of your income, expenses, assets, and liabilities. Reduces financial stress. So a large part of budgeting for people is the stress that it brings. And so what I'm going to teach you today is a way to reduce stress in your overall budgeting process. Number 3, it optimizes budgeting and expense control. So it really puts you in control and, again, creates awareness of how you spend money, how you bring money in. Number 4, it encourages savings and investment growth. So because you have a strong handle on how you spend money, it allows you to make better decisions around saving money and actually set some savings goals for yourself. Number 5, prepares for emergencies. So it's good to have money set aside when you need it, and rather than having to go into debt or tap into your investments, having an emergency fund is very important. Number 6, avoids debt and high interest payments. So again, not having to tap into debt allows you to only use what you saved and therefore avoid any interest payments. Number 7 is supports your retirement planning. So great to get this process in place as early as possible, but it's never too late. So if you're looking at doing retirement planning now, This is a process that will definitely help you get ready for retirement. Number 8, maximizes financial opportunities. So I think that a lot of opportunities come out of nowhere for us that are financial opportunities. And so making sure that you have money available for those opportunities is what this strategy would afford you. Number 9 is enhances financial discipline and awareness. So this is a technique today that's going to make it super simple to manage your cash flow. And it really helps for you to expand your understanding of how money works as well. And then it helps you to achieve those other goals. And so number 10 improves long-term wealth accumulation. This really, again, is the foundation of that. And from this cash management strategy, it allows you to save more money, do a lot of things that a lot of people find challenging. I'm not sure why my PowerPoint is not cooperating. Here we go. So common financial challenges to cash management. Irregular income and unexpected expenses. So depending on where you work, if you're still working, your income may vary, and that can be challenging for a budget. And then, of course, unexpected expenses that happen every year for me. These can really tap into your savings and can throw off of a budget very, very simply. So we'll talk about some ways to address that. Overspending and lack of budget discipline. So this is a big deal for people who are trying to save money for retirement, or people who are already retired and living off of their assets. Overspending can get you into trouble, can get you into unnecessary debt, or to spend down your assets faster than you expected to, and therefore potentially run out of money. So creating that discipline is going to be important for retirement. And managing debt while maintaining liquidity. So a big part of paying down debt is saving money so that you don't go into future debt. And so I've always talked about, if you have debt, paying it down, but setting aside money into a cash reserve that builds every month. And that way you can avoid ever going into debt again. And then inflation and rising cost of living. So one of the problems that a lot of people face is they keep too much money in cash, and it doesn't keep up with inflation and the rising cost of living. So one of the things that this strategy does is tells you how much exactly to keep in cash. And then from there, you can start to move those additional dollars over into your investments. Lack of financial knowledge and planning. So education is the key to wealth, to growing your wealth. And this is, again, a foundational part of growing your wealth. So today you're going to learn some really good information about how to manage cash flow, which again will springboard you into some other areas as well. Emotional spending and financial stress. That's another big thing that gets people in trouble. So there's a psychology to money. And once you understand the psychology of it, and then you understand yourself more in terms of what your triggers are that cause you to overspend, then you can begin to address those issues. And so awareness is key. And that's part of what this does for you, is creates awareness, but also, again, making decisions. And when it comes to emotional spending, when it comes to any bad habit, you have to replace it with something else to stop doing it. So finding a replacement to emotional spending is the key to getting over that. Okay, so those are the benefits and some of the challenges. Let's talk about goal setting now. And so goals are important because they create a clear financial roadmap and provide direction and motivation to you. Helps you to avoid impulsive spending, improves financial discipline, enables better decision-making in saving, investing, and debt management. When you think about goals, specifically financial goals and how to structure money, you tend to think of them as short-term, medium-term, and long-term goals. And that's just basically a time frame. So 0 to 2 years are short-term, medium-term, 2 to 5 years, and the long-term 5 years plus. And kind of as a general rule of thumb, short-term goals, 0 to 2 years, that's what you want to keep at your local bank. And just have that ready to go for yourself. That way it's safe. It's not, subject to market volatility, and you can get to it easily. Medium-term goals, that's where you can go into more things like short-term bonds, where you can, these are relatively safe, low volatility, things that can beat in terms of the rate of return CDs and savings accounts. So the idea here is we're trying to increase the rate of return, but so that we're not just sitting in cash doing nothing. And then, of course, long-term goals, that's where stocks come in handy. So if you want long-term growth, stocks provide the most growth over time historically. But keep in mind that the trade-off is volatility. So that's generally why you want to structure your cash or your investments this way, is because you don't want to have to tap into your long-term investments in the short term, because you may experience a drop in the markets. So that's why it's good to have these short-term buckets. And a familiar approach to goal setting these days is called the SMART approach. SMART is an acronym. It stands for specific. So your goals are clearly defined, and that defines exactly what you want to achieve. Measurable. So set quantifiable targets. So I want to save 10,000 in 12 months as an example. Achievable. So they need to be realistic. I want to save $1 million in 12 months. May be difficult if you only make 100 grand a year. So they need to be realistic. And same thing with expenses, is that, I'm going to cut my expenses by 40%. Well, that may be hard, and you're still able to eat. So you've got to consider what is actually achievable. Relevant, so they need to align with goals and with your priorities and your financial capacity. And then time bound, you need to set deadlines for yourself, and then have accountability as well, an accountability process in place. And tracking is a big part of goal setting. So continuously checking in on where you're at and relative to the goals that you're trying to achieve is very important. And so having a tracker is a good idea. A goal setting tracker helps you to do that. Okay, so here are some strategies for financial growth. Obviously, if you want more money, you should save more money and you should grow that money. So again, is where you position that money matters. And if you structure it in those 3 different buckets that I just talked about, that allows you and affords you the ability to make more money on your investments. Boost your income stream. So, more and more people are looking for ways to get additional income. I always remember my grandfather, he always had 3 jobs. And I think that was part of that generation, is that they just continuously, if it was daylight, they were at work. And so that was built into that generation. Now, these days, it's never been easier to actually have 2 or 3 jobs because of the internet. You can actually do consulting work on websites like Upwork.com, which is a contractor website. So you can be, as an example, like a virtual assistant. And through that website, you'll get paid from whoever hires you. Of course, there's things like Uber, where you can go be an Uber driver. My daughter is a driver, and so she makes her extra cash driving people around. I don't really like that, but she does it anyway. And so there's lots of ways to create additional income these days. And then reducing debt. Obviously, to grow your wealth, getting rid of the bad debt is a good idea. And so what is bad debt? Kind of discretionary spending. So clothing, travel, things that you don't necessarily need is that bad debt, so to speak. Good debt is debt to buy a home, debt to buy investment properties, or to buy a business, things like that. That can actually help you get ahead. So this is talking about specifically getting rid of the bad debt. Again, tracking is important. So regularly reviewing and adjusting goals based on any financial changes that may come about is very important. You have unlimited apps these days. So apps and spreadsheets. I'm a spreadsheet guy, so I've used spreadsheets forever, but there are lots of apps out there that allow you to track your goals. Seek guidance from financial planners or personalized strategies. I think that's one of the jobs that we fulfill for our clients, is that we help them to define those goals, and then we set up a plan with deadlines, and then continuously track those goals to help them to stay on track, and then make adjustments as necessary. So if something comes up that changes the goal, we talk about, here are the adjustments that we need to make. So good to have an accountability partner when it comes to goals, because they can help you to stay on track. Budgeting and expense tracking. So the B word, as we call it, because nobody likes to talk about budgeting, but it's very important. And so setting a budget for yourself will create awareness of how you spend money. It also is a way for you to set some goals for yourself. And so it's not just about awareness of how you spend money, but it's about setting those goals for what you'd like to improve, where you want to be. That might be income goals. So in 5 years, I want to have a much better paying job, or I want to create additional sources of income through side hustles, things like that. Those are all important to think about. And the process of creating an effective budget is simply just taking we have a template that we use, but I think Google, if you just type in, if you go to Google Sheets, one of the first sheets that is the template is a budget tool. So you have unlimited tools to create a budget, but what you're identifying are key variables, things like fixed cost, things that don't change, such as rent and utilities, and then variable costs like groceries and transportation, and then discretionary spending. So all of these are your expenses that you're defining. And keep in mind that you pretty much have a limited ability to change fixed costs unless you downsize your home, or you get rid of a car or something like that. Variable costs is where you have some control over. So you may start to meal prep, as an example, to bring your grocery costs down. So it's changing habits, and really changing the way you think about spending is how you're able to budget more effectively. And of course, discretionary spending, that's where you have the most control. And so with discretionary spending, that's where you can set goals for yourself and reward yourself. So, if you say, I want to spend X amount of dollars on travel, make sure you're saving for that. And then that's your reward for saving to that bucket, and really for doing very well with your budget. So a large part of budgeting, the psychology of it, is rewarding yourself when you do well. There's an old rule called the 50-30-20 rule, and this looks at basically where you allocate your income. So 50% of income go to your needs, 30% to your wants, and 20% to savings and debt repayment. And by using this tool, it's just something simple you can use, and you can use a spreadsheet to help you see where your expenses are allocated now. But there again, you've got other apps that you can look at. So a very easy rule of thumb to help you to see how you're doing. The key to success is regular review and adjustment, ensuring the budget evolves with life changes. And by prioritizing savings, managing spending, and avoiding common pitfalls like underestimating expenses, individuals can achieve both financial stability and long-term growth. And how to identify and reduce unnecessary spending. So tracking those expenses is key. And so you can use an app. Apps make it super simple to just download your information from your bank, or you can use spreadsheets. Categorize spending, so needs versus wants. So again, identifying what the expense is, which category of expense. Look for patterns in impulse purchases, so like dining out, unused subscriptions, and luxury items that you don't need. So setting a budget means setting a spending limit. Using the 24-hour rule says, wait a day and see if I still need this. And so that helps reduce those impulse purchases. Switching to cash payments or debit card payments from credit card payments is something I'm going to talk about with the strategy. Cancel or negotiate bills. So, again, is getting rid of unnecessary subscriptions, negotiating bills like hospital bills, things like that. Smart shopping habits. So planning what you're going to purchase in advance rather than going and buying stuff when you're there that you don't necessarily need. Those are all ways to help reduce that. So let's go into the cash management strategy now. Before I get into this, let me give you a backdrop here. So I've been teaching this for probably about 17 years now. And I will tell you that, so how this came about is there are various budgeting techniques out there. And when I was new into my career, I did a lot of reading, and I wasn't really quite satisfied with what I was doing at the time. So I did a bunch of research and I developed this strategy, and over time it evolved. And so this is the last iteration, probably from, I don't know, 10 years ago, that the last iteration came about. And I'm sure over time I'll have to create new changes to it as technology continues to advance. But the feedback that I've heard from clients over the last 15 years of teaching this is that things like, Josh, this changed my life. Josh, I don't know how we saved so much money. Josh, I don't know how we budgeted before we ever did this. This made it so easy. So this is probably one of the most talked about strategies that we teach, just because of the impact that it has on people's lives. And then secondly, what I would tell you is if you have children of all ages, I would teach them what I'm about to teach you, because it has that much of an impact on, it will have a huge impact on the younger people's lives. And I'll tell you why in just a minute. But even if you're retired, it has a huge impact on your life. As I go along here, folks, feel free to type in the chat. So don't be afraid to ask questions or ask me to repeat something. I'm happy to repeat it. You might get lost looking at some of this stuff. So this is how this works. And first of all, what this process will do is help you to manage your cash flow, anticipate upcoming bills, prepare for unexpected financial events, and help you achieve your financial goals by helping you to save a good amount of money that you would have never saved before can be saved by using this process. And then also by allocating your cash into the buckets that I described earlier, so that you can maximize the amount of money that you're making on your investments. So here's the main chart. The subsequent slides will show you each of these broken down. And so let's start here. The first part of this is how you pay yourself. And so most people, when they get paid via direct deposit into their bill pay checking account. So money comes in, I pay my bills, whatever's left over is what I live off of. This strategy uses what's called a buffer account. And the official name on this sheet is called the accumulation account, but it's a buffer account. The buffer account is where I take a checking account and I put all my money into it. So same thing you're probably doing now. The difference is that this is not the account that I pay my bills from. So what happens is on the first of the month, I transfer 1 month of my expenses into the second account, which is the bill pay account. And so the bill pay account is also a checking account. And so I'm just going to use a really simple example here. Let's say that your net take home is $10,000 a month. Again, it's arbitrary, so yours may be much less, yours may be much more than that. But $10,000 a month, it comes into my bank accounts net. So I've paid taxes on it, and that's what I get. On the first of the month, I'm transferring $10,000 to my bill pay account, my checking account number 2 in this example. And you'd say, well, what do you do that for, Josh? and the reason is that this puts you in control of your expenses. And so, of your income. It puts you in control of your income. And so most people, as they earn money in life, the amount of money that they make increases over time. And what happens is they acclimate to those pay increases. So they spend it. They weren't making it last year, but somehow they found a way to spend it this year. And so what this strategy does is it locks in your lifestyle. So back to that example of 10,000, let's say I get a pay raise, and now now I'm making 10,500 a month. So 10,500 comes into the accumulation account, and then 10,000 transfers automatically in the first. And that's an auto transfer that I set up through my bank, essentially. So these all have to be at the same bank. So via that auto transfer, 10,000 transfers, that means $500 in that example stays in the accumulation account and accumulates. And therefore, I don't change my how I pay myself, the amount that I pay myself until I need it, rather than when I get it. So the benefit of this also is that many people get paid additional money that typically gets spent. Things like overtime pay or bonuses. Many people get paid 26 times a year. That's 2 extra paychecks that you get paid that somehow you find a way to spend. So what this account does is it takes those additional dollars and it accumulates it over time. And this is very powerful, folks. This very simple strategy is very powerful. This is where people say, I've never saved so much money in my life, Josh. And it's so simple to set up. You just go set up 2 checking accounts at your bank. If you have an existing bank account, you can either keep everything there and then set up that bill pay account, and you just have to pay all of your vendors from that bill pay account. Now, let me talk a little bit about how you pay your bills. So most people today have heard of online bill pay through their bank. It's a free service. You can go on there, you can type in the vendor's information, and you can send the money at your discretion, or you can set it up to be repeating. You can also, with a lot of banks, they'll send an e-bill directly and it will pay that amount for you. So it set it up automatically. So, 10, 15 years ago, nobody heard of this, but it's been around that long. And so what's nice about this is you can set up all your vendors on your online bill pay, and you can set them all to be recurring. And in doing so, that makes bill pay easy. Now, the other part of this is when you pay your bills. So paying your bills at the beginning of the month. I use the 3rd as an example. So all of your bills paid at the 3rd of the month means that whatever's left over at the beginning of the month, or after you pay all your bills, is what you live off of. So it's a way to budget very simply. I know that if all of my bills are paid, what's left over is just simply my variable expenses like groceries, eating out, things like that. And I can budget that money much more easily because I know that all the main bills have been paid. So paying all your bills at the beginning of the month is a very easy budgeting technique. One thing to mention, and by the way, before I move on from this, a lot of people will say, well, my bill's not due until the 25th of the month. So you can do two things. You can call the vendor and you can ask them to change the due date to earlier in the month. And therefore the statement date comes out earlier so you can pay that bill. You can also just pay your bill early. So, if it's a variable amount, you can just pay a little bit over. And then what I do once a month is I just go in and I check all of my bills. And it literally takes me 5 minutes, folks. So I do have some expenses that will vary greatly. So I have to go in and put an entry in for that. But literally it takes 5 minutes. Whereas back in the old days, I used to get statements in the mail. You pull out your old checkbook and you write a check, and it's happening throughout the month. And so it's just that process of remembering to pay bills. Okay, did that bill come in yet? Yeah, I need to go pay that bill. To having a system in place where I know all of my bills are paid at the beginning of the month. Hopefully that makes sense to you. One thing I want to mention about this accumulation account is that what this requires you to have is 1 month's worth of expenses saved. So in that example, I used $10,000. I need what we call seed money. Seed money means I need to put $10,000 in that accumulation account, because what's going to happen is on the 1st of the month, that's going to transfer over to the bill pay account. And then from the rest of that month forward, I'm going to get paid whatever frequency I get paid to replenish what was just transferred, so that by the end of the month, 10,000 is back in the account to transfer on the first. So if you don't have that amount of money, you can split this up into paying half your bills in the beginning and then half your bills in the middle of the month. But the idea is that the goal is to get to where you've got 1 month's worth of expenses saved and you can just pay all your bills at the beginning of the month. So that's the first part of this. By the way, the other thing you can do on the bill pay is you can have it draft your account at the beginning of the month. So again, all of my bills come out mostly on the 3rd. I have some that have to go out on the 1st, but mostly on the 3rd is when I send them all out. If you do have a question, I see that you raised your hand, Brenda, but if you want to type it in, I'm happy to answer your question. And we tested the chat at the beginning. Let me make sure. Oh, here we go. Now you can chat. So try that now, Brenda. If you want to type it in there, I'll answer a question that you have. Actually. Okay. Oh, there it is. Okay. Yep, and I'm going to talk about credit cards in just a moment, actually. So I'll ask her a question in just a moment, everybody, and then tell you the answer. So thank you for that comment, though. Let me move us to the next slide here. Okay, now let's talk about the second component of this. And these are other accounts. And so these are a series of savings accounts and checking accounts, and then a couple of cards. And so the first thing I'll tell you is you say, that's a lot of accounts, Josh. And it is, but it's a way to make this super simple. And the banks don't care how many accounts you have. You can set up free checking accounts. They call them college accounts, so you don't have to pay any cost for them. Savings accounts are usually free anyway. So let me explain this to you. We have 3 savings accounts. We'll start with the first one, the emergency reserve account. These are for unexpected expenses. And so these are for things like illnesses, injuries, home or car repairs, things like that, things that you did not expect. So the idea here is you define how much money you want to keep in an emergency reserve. And typically what's recommended is before the age of 59 and a half, anywhere from 6 to 12 months of your living expenses is what's recommended. After you're 59 and a half, though, you have access to your retirement account without penalties. And so you still want to structure it properly, but it's done a little bit differently. It's typically we tell clients anywhere from 10 to 20,000 is what you want to keep at your bank, have saved as an emergency reserve. That way you have ready access to that money. And so if you have that much cash now, you just simply allocate it to this account and you label it. And that's the key here is you label these accounts so you know what they are. And you can do that at your bank's website. And the other thing that you want to do is you want to save monthly to these accounts. So it's a monthly transfer on the 3rd of the month or the beginning of the month, and it's an auto transfer. So whatever amount that you want to save to the emergency reserve account, you just say it's $100 a month. $100 goes from that bill pay account via auto transfer on the 3rd to this emergency reserve. And the idea behind that is even if you funded it, let's say that's 10,000 is your goal, even if you put $10,000 in there, you still want to automatically fund it because you want to replenish it. Expenses will come up. You'll need to pay the expenses. You'll need some sort of replenishment process. And that's where I say saving $100 a month is a very simple way to do that. Notice the arrow goes up also. So when you need money, you just simply transfer it to your bill pay account. The beauty of having one account that everything distributes from is that you can easily go back and research something on one account. You don't have to remember, okay, where did I pay my property taxes? Well, that's right, I paid it from this account over here. So having one account allows you to research things very easily. It's also very easy to use the budgeting software to just download from one account. So emergency reserve, save to it monthly, and then again, define the amount of cash. The expense account are for expected expenses. So these are expenses that come up infrequently throughout the year. So once or twice a year that oftentimes are left out of your budget. So things like property taxes and insurance, if you don't escrow, you have to save for those each month. And things like travel. So if you like to travel, and even in retirement, you like to travel, you want to save monthly to that expense. And then gifts, if you like to gift money to at Christmas time or whatever holidays you celebrate, saving money to this account is important. And so what you do is you define the total amount of expenses, total amount of budget, the annual, I should say, the annual amount. And let's say that's $12,000 for all of this. So $12,000, I would save $1,000 a month to this account. And then when that bill comes due, I just simply transfer it back up to the bill pay account and pay that bill. So these are what I call budget busters. People don't always remember to save for these things. And so there again, it's something that you're aware of, that's expected, and you have an annual budget for it, and you just divide by 12 and you save monthly to it. Third is the car fund. So the car fund is the idea of paying cash for cars. And folks, I have always paid cash for cars. Now, I didn't always drive nice cars. So my original cars were the old junker cars, but I always paid cash for them. And it was because of this idea. It is that a couple of things actually is that, number one, if you write a check for a car, you're much more likely to consider the amount of money that you're paying for that car. And I always give this example. A few years ago, my wife wanted a Suburban. We've got 3 daughters, and she wanted a Suburban. And she drove a Suburban, then it died, and she wanted to replace it. And we went to go look at the Suburbans. And back then, the Suburbans were like $70,000. And then so we also looked at a Toyota Sienna. I talked her into looking at a Toyota Sienna. And the Toyota Sienna was half the price. And so I said, honey, would you like 2 Toyotas or 1 Suburban? And she said, okay, I'll buy the Toyota. So we bought the Toyota. So again, the point is that you think a little bit more about the car value. And what the car industry has done a fantastic job of doing is converting an amount of money to pay to a payment. So you can afford a $500 payment, right? Or a $700 payment. Now it's $1,000 payments. That's affordable to you, right? Well, who cares what the price of the car is, because you can afford the payment. And very masterful on their part, but for you, not so good, right? So car fund allows you to think about the price that you pay. The other thing that it does, obviously, is it helps you avoid paying unnecessary interest. So by not paying the interest on it, you can actually earn interest on your money. So the way to do this, folks, is you define the value of car that you're going to write a check for. So after your trade-in, what am I going to write a check for? And then you define the amount of time that it's going to be until you buy that car. And you divide that by the number of months that it is until that time frame. So if I'm going to buy a $60,000 car in 5 years, that's $1,000 a month that I need to save to buy that car. Is a really very easy example. The other great thing that this does for you, by the way, is that if your car breaks down, this gives you one additional bucket that you can go to fix that car. And the benefit of that is that by fixing your car, it extends the life of your car. And therefore, you can push that purchase out a little bit farther if you want to. So saving monthly to that. And then again, when you need to buy the car, just transfer it back up into your bill pay account. Okay, so those are 3 savings accounts. Free, very simple, earning interest, all good for you. The next 2 are checking accounts, and this is where the real budgeting comes into play. And so we call them allowance accounts. Now, 1 and 2 is if you're married. If you're single, you just need 1 account. And my wife and I have done this for many, many years. The idea behind this is that with the money that's left over, after you've paid all your bills, that's your discretionary spending, right? Well, depending on what type of spender you are, you may spend through that very quickly, or you may spend it, or you may never spend it. And typically in a family, you have a spendthrift, so people who will spend through money quickly, and you have the savers. Sometimes you have two savers, and that's an incredible combination because they save a ton of money. But typically there's a spendthrift and there's a saver. And so what this strategy looks at doing is funding an allowance account, and we fund them weekly. And so once a week, you have an auto transfer that sends whatever amount of money that you decide into your allowance account. And it doesn't have to be equal. My wife gets much more money than I get because she pays for the groceries, the kids' clothing, things like that. Whereas all I really pay for is eating out. So I take her to dinner once a week, and the kids sometimes go along. And that's what my money's used for. So I don't get near as much money as she gets. But so the point is it doesn't matter that they don't have to be perfectly equal. But the benefit of this is that my wife will gladly tell you this, is that she's a spendthrift. She would be, and again, the evolution of this is I would give her a monthly allotment and she'd be out of money in 2 weeks. So the weekly allotment means that if she runs out of money for the week, she just waits till Monday. And that's kind of been a joke in my house for years now, is we got to wait till Monday because I'm out of money. And the kids are like, dang it, Mom, I guess we'll wait till Monday. But what that does is, again, is it helps you to build that discipline to spread out the payments. And by the way, so how does she spend money? She uses a debit card. So debit cards function just like credit cards. There's no difference except that they have a limit in terms of how much you can spend. So, and most people know this now, but you can use a debit card as a credit card. You don't have to type in a code every time. You can just choose the credit option and it will function as a credit card. But what it doesn't have is an unlimited ceiling of amount of money that you can spend. That's the key difference, right? So we've both used debit cards for many, many years. And again, that's helped us to develop the discipline to stay on our budget. So hopefully that makes sense to you. And then looking at the last two here. So credit cards, and Brenda brought this up earlier. Credit cards are fantastic because they provide points to you. However, they can also get you into trouble. So, and again, I didn't mention this at the beginning, this is only suggestions for you folks. Obviously, you can adopt whatever you like about this. This is a strategy that has worked very well for many years for my family. And of course, clients adopt different versions of this, whatever works for them. So many people use credit cards and they're just fine. It doesn't get them into trouble, but many don't. And so what I recommended to use for a credit card are non-discretionary spending. So recurring expenses like your mobile phone bill, your Netflix subscriptions, things like that are recurring expenses. They allow you to get those points, and so you'd be spending that anyway. So you might as well spend it on the credit card and get the points. But my philosophy is to leave home without it. So part of that discipline process is to not have it in your wallet, so that you don't do those unnecessary purchases. So again, it's totally up to you. But what this allows you to do is to stay on budget. A lot of people will say, but Josh, I always pay my credit card off at the end of the month. Well, that's fantastic because they're working and they're making extra money to pay those extra expenses. They might use a bonus or a tax refund is a common answer. Well, I use my tax refund to pay off my debt. That's all fantastic, except when you retire. When you retire, you have a fixed amount of income, you have a fixed amount of assets. And if you draw down your assets too quickly, you could run out of money. Usually when we recommend drawing down your portfolio, it's a percentage of your portfolio. So obviously, if you draw down too much of your portfolio, that percentage of that portfolio is less money that you're getting. So again, it helps you to avoid the mistake that a lot of retirees make, which is spending down their assets, thinking that they're doing okay because they're able to afford it, but they're unnecessarily creating risk of running out of money. And then lastly, the fuel card. The fuel card is something that my family used because I have 5 drivers in my family. And the beauty of a fuel card is that you can limit the purchases to only fuel. So we use a Murphy fuel card. We live right by a Murphy gas station. And so my kids can go fill up their tanks, and they can't go in and buy a Coke. So the reason why we use fuel cards is because fuel is difficult to budget. The prices are always varying, and you're going to different locations, different places that require more fuel. So that was one thing that would always throw my budget off, was fuel. So I decided to use this strategy, and it's worked great for years. So it's a way to, again, not blow up your budget with fuel. So again, you've got 2 checking accounts at the top. You don't see that. Let me see if I get the full picture here. Yeah, the 2 checking accounts at the top, and then 2 checking accounts here if you're married. If you're single, you just need 1. So that 3 or 4, and then 3 savings accounts. And then depending on your philosophy on credit cards and fuel cards. Now, keep in mind is, credit cards, they help you with your credit, which also helps with your driving, your insurance. And so you don't necessarily want to just get rid of all your credit because it can benefit you. But you definitely, what I always tell people is I'd much rather have a higher bank account than a higher credit score. And so if credit gets you in trouble, if your credit cards get you in trouble, just get rid of them. Get used to using a budget, because people use them as kind of safeguards, and a lot of times it's for unnecessary spending. And that is the strategy. So hopefully that was useful and educational for you. Here are some final takeaways. So just to recap, very important to have cash management to help you to reach your long-term goals. Budgeting is a key component of that cash management strategy, and I spoke about a very simple budgeting technique today. Building and managing cash reserves helps you to stay out of debt, and also helps you sleep at night, so because knowing that you've got money set aside. Identify and reduce unnecessary spending. So again, getting rid of expenditures that aren't necessary. The big thing these days is subscriptions to stuff. So, monitoring those. Optimizing cash flow for future growth. So again, bucketing your money to maximize the amount of interest that you can make. So what are some action steps you can take? Assess your current financial situation. So just see where you're at. Create your budget. Again, using the tools that are out there makes it very simple. Reduce unnecessary spending. So identify those expenditures and eliminate them. Build your emergency fund. That will help you to have money when you need it. Manage and reduce debt. So eliminating debt, especially going to retirement, is a great idea. And then planning for long-term growth. Again, making sure you've identified the amount of cash that you need to keep it in cash. And by the way, I didn't mention that. Part of this is identifying how much cash you need to keep in cash. So in the emergency fund, the expense account, the seed money for the accumulation account, the car fund to fund it to if you're going to pay for cash for the car. And those 4 buckets, once you've identified the amount of cash that you need to keep, also keep in mind any large expenses that are coming up in the next couple of years, you may want to keep in cash as well. That's where you should funnel the rest of that money into your more long-term investments. Okay. Any questions, folks? I'm going to stick around for any questions. Otherwise, thank you very much. If you'd like to receive our newsletters, you can go to strittmatterwealth.com/newsletter. We've got some fantastic newsletters that we send out that are highly educational. If you're not a client of ours and you'd like to be, and if you'd like to learn more about us, we have a complimentary discovery meeting. You can click on this QR code, or you can go to this website here, strittmatterwealth.com/discovery-meeting, and schedule a complimentary meeting. All right. And I do see we have a question here. Oh, you're very welcome. You're very welcome. I hope that this was beneficial to you. So again, folks, I'll stick around for any questions that you have. Otherwise, have a fantastic rest of your week. Hope you stay warm, and just give us a call if we can help.